Jeff Rosenkrantz, fixed income portfolio manager on the fixed income team at Shelton Capital Management. Here today to talk a little bit about the power of duration when it comes to bond investing and the risk of reinvestment in the current interest rate environment. Why now is a really good time for you to consider moving some of your client assets out of short-term T-bills and into longer duration bond investments, whether they be treasuries or high quality corporate bonds. Last year was a terrible year for fixed income as the Fed raised rates to try and combat inflation, and this caused losses on bond portfolios. Well, we're nearing the end of the rate hike cycle, and our belief is that at some point rates will start to go lower. We don't know exactly when, but it is going to happen. And even Fed Chair Powell last week had his press conference after the FOMC meeting, said as much, that eventually they're going to have to lower rates as inflation starts to come down to keep real rates from going too high. So let's take a little bit of a look at the math behind what we're talking about. In this slide, we've laid out 5 different bonds. One is a 6-month T-bill. The next is a 10-year U.S. Treasury. The third is a 10-year bond from Meta Platforms, Inc., formerly known as Facebook. The fourth is a Warner Music Group bond. And the last is a bond from Kraft Heinz Foods. And so what we're trying to depict here is a menu, if you will, of different degrees of duration and credit risk. And what we're trying to show you here is by taking a little bit more duration risk, you can generate substantially higher returns on bonds if rates start to decline, even modestly, even 25 or 50 basis points. So let's walk through a couple of examples. If you were invested in a 6-month T-bill and rates stay constant for the next year, you're looking at about a 5% total return. Where we get into reinvestment risk is, let's say rates go down 25 or 50 basis points between now and when that 6-month T-bill matures. Well, you're going to be reinvesting those proceeds into another T-bill that's yielding less because rates have gone down. So if rates go down 25 basis points, then your total return over the next year would be 4.95%. If we take a little bit more duration risk, remember, this is nothing to do with credit quality, so just a 10-year treasury and rates go down 25 basis points, then you're looking at a 5.7% total return over the next month. So decent amount of incremental yield. Now, if you're willing to take a little bit of credit risk on top of that, again, these are high quality corporate bonds. So Meta Platforms, A1 AA rated, very strong credit. A 10-year Meta Platforms bond would generate 6.7% total return over the next year if rates go down 25 basis points. If we take it out to Warner Music Group, which is a BA2 BB plus bond that we really like, that would be a 7.9% total return. And lastly, a Kraft Heinz food company, very defensive sector in consumer discretionary food and beverage, 9% total return because you are taking more duration risk. It's about a 13.5 duration on this bond. And if you look at some of the other data on this sheet, you'll see that if rates were to decline more than 25 basis points, the total returns go up even more. And to the point where if rates go up 75 or more basis points, you're really looking at equity-like rates of return in the double digits. So the opportunity cost of what you're missing out on if you stay in short-term T-bills is greater the more rates hypothetically go lower. So we suffered the consequences last year from rising rates. Now is the time to think about getting your revenge as rates eventually start to head lower. Strong total returns are potentially available, and you run the risk of reinvesting at lower rates if you stay in T-bills. So we're happy to talk to you in more detail about this. Please reach out to your Shelton representative, and good luck investing out there, and don't miss out on this, significant opportunity to generate not just income, but total returns eventually when rates start to go lower. Thanks very much.